Here's a question that will expose how little you actually know about the 2008 crash. What business was Lehman Brothers really in? If you answered investment banking, you're technically correct, but completely missing the point. Yes, Lehman was classified as an investment bank, but by 2008, that activity made up less than 5% of their actual business. If you said mortgage lending, still wrong. The truth is so much stranger and more dangerous than the simplified story everyone tells. This Alabama dry goods store somehow became a financial monster that nearly broke the global economy, and understanding what they actually did reveals why 2025's market looks terrifyingly familiar. The story starts in the most unlikely place imaginable: the Alabama dry goods store that became a financial monster. Henry Lehman opened a dry goods store in Montgomery, Alabama in 1847, selling basic supplies to cotton plantation owners. Within 3 years, his brother Emanuel joined him, and they changed the name to H. Lehman and Bro. 3 years later, their third brother mayor came aboard, and they settled on Lehman Brothers. This wasn't just a family business expansion. It was the first sign of a pattern that would define the company for the next 160 years. They refused to stay in one lane. The brothers made a decision that seemed smart at the time, but revealed something dangerous about their approach to business. Cotton plantation owners often ran short on cash, so the Lehmans started accepting raw cotton as payment for their merchandise instead of requiring currency. They routinely accepted this cotton as barter, reselling it for significant markup. This flexibility helped them make more sales, but it also meant they were now in two businesses at once: retail and commodities trading. Most store owners would have stuck to selling goods and demanded cash payment. The Lehman Brothers saw an opportunity to make extra money by taking on the risk of cotton price fluctuations. They were essentially betting that they could sell the cotton for more than the value of the merchandise they had traded for it. This wasn't just customer service. It was speculation disguised as convenience. The Civil War should have destroyed their business. Cotton markets collapsed, and the South's economy was in ruins. But the brothers adapted again, this time moving their operations to New York in 1858, just before the war began. They had seen the writing on the wall and made another business model change, shifting from southern retail to northern commodity trading. Their timing was perfect, but their success came from abandoning their original customers and location when it became profitable to do so. After the war, they expanded into coffee, petroleum, and other commodities. Each new market meant learning different risks, different customers, and different profit margins. The brothers weren't building expertise in any single area. They were building a culture of jumping into whatever market offered the best returns at the moment. This opportunistic approach worked during the rapid economic expansion of the late 1800s, but it created a company that never developed deep knowledge about managing long-term risks. Their success in commodities led them to start underwriting bonds and handling financial transactions for their trading clients. By 1870, they had helped found the New York Cotton Exchange, commodifying the crop that had launched their fortune. By the 1880s, they were no longer just commodity traders. They had become financial intermediaries, using their reputation and capital to help other businesses raise money. This evolution happened gradually, but it represented a fundamental shift in their business model. They were now making money not just from buying and selling physical goods, but from managing other people's financial risks. The pattern became clear. Every time the Lehman Brothers saw a new way to make money, they entered that market regardless of whether it fit with their existing business. They moved from retail to commodity trading to financial services, not because of strategic planning, but because each transition offered higher profits. This flexibility made them successful, but it also meant they never developed the institutional knowledge that comes from focusing on one area of expertise. Their approach to business was fundamentally different from companies that built sustainable competitive advantages through specialization. Instead of becoming the best at one thing, they became good enough at many things to profit from economic opportunities as they arose. This strategy worked in the rapidly changing economy of the 19th century, but it created a company culture that prioritized adaptability over stability. The brothers' willingness to accept cotton as payment revealed their fundamental approach to risk. They were always willing to take on additional risk if it meant additional profit. They didn't see themselves as store owners who sometimes dealt with cotton. They saw themselves as profit seekers who would enter any market that offered returns. This mindset would define every major decision the company made for the next century and a half. By the 1890s, Lehman Brothers had established itself as a significant player in New York's financial markets. They were underwriting railroad bonds, financing industrial expansion, and managing investment portfolios for wealthy clients. But they hadn't abandoned their commodity trading roots. They were simultaneously active in multiple markets, each with different risk profiles and profit potential. This diversification seemed like smart business, but it also meant that problems in any one market could spread throughout their entire operation. Their success came from leveraging relationships and capital rather than building products or services that customers couldn't get elsewhere. They were intermediaries who made money by standing between buyers and sellers, borrowers and lenders, investors and opportunities. This positioned them to profit from economic growth, but it also made them vulnerable to economic downturns that could reduce demand for their services across multiple markets simultaneously. The brothers had created a business model based on financial leverage and market timing rather than operational excellence or customer loyalty. They made money when markets were active and lost money when markets were quiet. This cyclical nature of their profits meant they had to constantly find new sources of revenue to maintain their growth, which drove them to enter even more markets and take on even more risks. Their move to New York marked the beginning of their transformation from a regional business serving local customers to a national firm competing with established financial institutions. This transition required them to build new capabilities, establish new relationships, and understand new markets. But instead of developing expertise gradually, they expanded rapidly into multiple areas at once, spreading their attention and resources across numerous different businesses. The flexibility that made them successful also made them unstable. Each new market they entered required different skills, different relationships, and different risk management approaches. Instead of building deep expertise in any single area, they built a reputation for being willing to enter any market where money could be made. This reputation attracted clients who needed financial services, but it also attracted risks that the brothers didn't fully understand. Their 19th century success established a company culture that would persist for generations. When faced with a choice between specializing in their existing business or expanding into new markets, they would always choose expansion. This growth-focused mindset drove their evolution from Alabama store owners to New York financial players, but it also created the foundation for their eventual downfall. The same entrepreneurial flexibility that made them successful in the commodity markets would eventually make them reckless enough to crash the global economy. But to understand how that happened, you need to look past the simple labels that everyone uses to describe what Lehman Brothers actually became. The investment banking lie everyone believes. In 2007, investment banking fees represented less than 5% of Lehman's total revenue. This wasn't just a technicality. It revealed how completely the financial media had misunderstood what Lehman Brothers actually was. Most people think investment banking means helping companies raise money by selling stocks and bonds to investors. That's exactly what investment banks do. But this traditional business had become almost irrelevant to Lehman's operations by the time they collapsed. Investment banking works like this. When a company wants to go public or raise money, they hire an investment bank to find investors and handle the paperwork. The investment bank takes a fee, usually around 7% of the money raised, and sometimes keeps a small portion of the stock for themselves. It's basically high-level matchmaking between companies that need money and investors who have money. The investment bank makes their profit from fees and commissions, not from taking massive risks with their own capital. Lehman Brothers first entered investment banking in 1899 when they underwrote the initial public offering of the International Steam Pump Company. This was their first attempt at connecting businesses that needed capital with investors who had capital. The deal worked, so they kept doing more IPOs. By 1906, they had partnered with Goldman Sachs to underwrite General Cigar, followed by major companies like Sears, Macy's, and Studebaker. This partnership made sense because it spread the risk between two firms instead of one firm taking on all the risk of a deal going bad. Their investment banking business grew steadily through the first half of the 20th century, but it remained just one part of their overall operations. They were still active in commodity trading, they had expanded into bond underwriting, and they were managing investment portfolios for wealthy clients. Investment banking was profitable, but it wasn't their main source of revenue. The fees were good, but they were looking for bigger opportunities. During the Great Depression, Lehman Brothers pioneered something that would later be called venture capital. While other firms were trying to survive the economic downturn, Lehman saw an opportunity to invest in small companies that needed funding to grow. They would provide capital to businesses that were too small or too risky for traditional bank loans in exchange for ownership stakes in those companies. This strategy allowed them to potentially earn returns far exceeding their initial investment if the company succeeded. This venture capital approach revealed something important about Lehman's business philosophy. They weren't content to earn steady fees from investment banking. They wanted to own pieces of the companies they were helping, so they could profit from their long-term success. This meant taking on much more risk than traditional investment banking, but it also meant much higher potential returns. They were essentially betting their own money on the companies they chose to support. The venture capital investments during the Depression proved that Lehman would enter any market where they saw profit potential. They invested in retail companies, manufacturing businesses, and technology firms. Each investment required them to understand different industries, different business models, and different risk factors. Instead of building expertise in one area, they were spreading their attention across multiple sectors simultaneously. By the 1960s, Lehman Brothers was involved in so many different businesses that even their own executives had trouble explaining what the company actually did. They were underwriting IPOs, managing venture capital funds, trading commodities, providing corporate advisory services, and managing investment portfolios. Investment banking was still important, but it was just one department among many. The company was making money from dozens of different sources, which seemed like a strength, but was actually a weakness. The problem with this diversification strategy was that it prevented them from developing deep expertise in any single area. Investment banking requires understanding how to price securities and manage underwriting risks. Commodity trading requires understanding supply and demand dynamics in physical markets. Venture capital requires understanding how to evaluate early-stage companies and manage long-term investments. Each business had different skills requirements, but Lehman was trying to be competitive in all of them simultaneously. The media and financial analysts kept calling them an investment bank because that was their most visible business line. When companies went public, Lehman's name would appear in the newspaper as the underwriter. But the IPO business was generating maybe 10% of their total revenue. The rest was coming from trading, asset management, venture capital, and other activities that didn't get as much public attention. During the 1980s and 1990s, Lehman expanded even further into hedge fund operations, private equity, and mortgage origination. Each expansion made them more profitable in the short term, but it also made them more complex and harder to manage. They were competing with specialized firms that focused on single business lines, but they were trying to be competitive in a dozen different areas at once. By 2008, calling Lehman Brothers an investment bank was like calling General Electric a light bulb company. Traditional investment banking fees represented less than 5% of their revenue. The vast majority of their income came from trading, asset management, and mortgage-related activities that had nothing to do with underwriting IPOs or advising companies on mergers and acquisitions. Their 2007 annual report showed over $19 billion in revenue from dozens of different business lines. They were operating hedge funds, managing private equity investments, originating mortgages, trading derivatives, and providing dozens of other financial services. Investment banking was buried somewhere in the middle of a long list of revenue sources, generating decent fees, but not driving their overall profitability. This diversification strategy that had made them successful for over a century became their fatal weakness in 2008. When the mortgage market collapsed, it affected their mortgage origination business, their mortgage trading business, their hedge fund operations, and their private equity investments simultaneously. A specialized investment bank might have survived the mortgage crisis, but Lehman had spread their risks across so many different areas that problems in one market created problems everywhere. The complexity of their operations made it impossible for anyone to understand what the company actually did, including their own employees. This confusion wasn't just an academic problem. It created a company where different departments barely understood each other's businesses, where risk management was nearly impossible, and where internal competition became more important than external success. The investment banking label had hidden the real nature of their business from regulators, investors, and even themselves, the devil's casino and the toxic culture that bred disaster. What this complexity concealed was an internal culture that made rational decision-making nearly impossible. During the 1970s, Lehman Brothers earned a nickname that revealed everything wrong with their operations. The Devil's Casino, as called by contemporaneous accounts and later memoirs. This wasn't just Wall Street trash talk. It was an accurate description of a company where employees treated every decision like a high-stakes gamble and every colleague like a competitor who needed to be destroyed. The nickname stuck because it captured the atmosphere inside Lehman's offices, where making money mattered more than making sense, and where short-term wins justified any amount of long-term damage. The bonus structure at Lehman Brothers created a war zone inside their own building. Departments competed against each other for resources, recognition, and year-end payouts. This wasn't healthy competition that pushed everyone to perform better. This was active sabotage where departments would withhold information, steal clients, and undermine each other's deals just to make their own numbers look better. The mortgage department would compete with the trading department. The investment banking team would fight with the asset management group. Everyone was trying to grab the biggest piece of the bonus pool, even if it meant hurting the company's overall performance. This internal competition made it impossible for anyone to understand what Lehman Brothers actually did as a complete business. Each department operated like a separate company with its own goals, its own strategies, and its own definition of success. The mortgage guys cared about origination volume. The trading team cared about daily profits. The investment bankers cared about deal fees. Nobody was looking at how these different businesses affected each other or whether their combined risks were manageable. The company had become a collection of competing fiefdoms instead of a unified organization. The toxic culture drove away some of the most talented people in finance. Stephen Schwarzman was chairman of Lehman's Merger and Acquisition Committee during the 1970s, but he left in the early 1980s to found Blackstone because he couldn't stand the internal dysfunction. Schwarzman later described the extremely competitive internal environment at Lehman as dysfunctional. He founded Blackstone, which became the world's largest private asset manager, partly because he had learned what not to do from his time at Lehman. Other future billionaires also fled the company during this period, taking their expertise and connections with them. The competitive bonus structure created perverse incentives that encouraged dangerous behavior. Employees were rewarded for generating short-term profits, regardless of the long-term consequences. A trader who made $50 million in profits during the first quarter would get a huge bonus, even if his trading strategy was guaranteed to lose money eventually. A mortgage originator who generated high volumes of loans would be rewarded, even if those loans were likely to default. The bonus system measured activity and immediate results, not sustainability or risk management. This focus on short-term gains prevented anyone from seeing long-term risks. Each department was optimizing for their own quarterly performance without considering how their activities might affect the company's overall stability. The mortgage department was writing risky loans because they generated immediate fees. The trading department was taking leverage positions because they generated immediate profits. The investment banking team was advising on deals that generated immediate commissions. Everyone was focused on the next bonus cycle instead of the next economic downturn. The internal competition also made risk management impossible. When departments are actively competing against each other, they don't share information about potential problems. A mortgage originator who discovered that certain types of loans were defaulting at higher rates wouldn't share that information with the trading department that was buying those same types of loans. The trading team that noticed unusual market movements wouldn't warn the investment banking group that was planning deals based on those same market conditions. Critical information stayed siloed within departments instead of flowing throughout the organization. The fragmented company structure meant that senior executives couldn't get accurate information about the company's total risk exposure. Each department would report their own metrics, but nobody was combining these metrics to understand the company's overall position. The mortgage department might report that they were only holding mortgages for 30 days before selling them, which sounded safe. The trading department might report that they were only buying high-quality mortgage securities, which also sounded safe. But nobody was tracking how these seemingly safe activities combined to create massive concentrated risk in the mortgage market. The culture also prevented effective oversight because department heads were incentivized to hide problems rather than solve them. If the mortgage department was having trouble selling certain types of loans, they wouldn't report this to senior management because it might affect their bonuses. Instead, they would try to find creative ways to move these loans off their books, often by selling them to other departments within Lehman. This meant that problems weren't being solved, they were just being shuffled around the organization until they became too big to hide. The American Express acquisition of Lehman Brothers in 1984 was actually a rescue from this toxic culture. American Express recognized that Lehman's internal dysfunction was preventing the company from reaching its potential. The acquisition was supposed to provide the capital and management structure needed to fix these cultural problems. American Express executives tried to impose more discipline and coordination across Lehman's different departments, but the underlying competitive culture was too deeply embedded to change easily. Even under American Express ownership, the competitive culture persisted. Employees continued to prioritize their own departmental success over the company's overall health. The bonus structure still rewarded short-term performance over long-term stability. The information silos remained intact, preventing effective risk management. American Express provided financial stability, but they couldn't fix the fundamental cultural problems that made Lehman Brothers vulnerable to catastrophic mistakes. The same competitive culture that drove short-term profits prevented Lehman from seeing long-term risks. The bonus structure that motivated employees to generate immediate results also motivated them to ignore potential future problems. The internal competition that pushed each department to maximize their own performance also prevented the coordination needed to manage risks across the entire organization. The Devil's Casino nickname captured the essence of a company that was gambling with its own survival every day. And eventually someone would have to step in and change the rules of the game entirely. That dysfunction would find its solution in the most unlikely person. A man whose obsession with loyalty would reshape everything about how Lehman Brothers operated. Dick Fuld joined Lehman Brothers in 1966 at age 23, fresh from an Air Force expulsion after an alleged altercation that ended his military career before it really began. Most people would have seen this setback as a reason to keep their options open, but Fuld did the opposite. He committed to Lehman Brothers with the intensity of someone who had already lost one opportunity and refused to lose another. Over the next 40 years, he would experience every phase of the company's evolution, from the toxic culture of the Devil's Casino era through the American Express acquisition and beyond. Fuld's loyalty to Lehman Brothers became an obsession that shaped his entire worldview. He watched talented executives leave during the 1970s and 1980s to start their own firms, and he took each departure personally. When Steven Schwartzman left to co-found Blackstone, Fuld didn't see it as a natural career progression. He saw it as betrayal. When other executives departed to launch their own ventures, Fuld viewed them as traitors who had stolen Lehman's training, connections, and institutional knowledge for their own benefit. This perspective on loyalty wasn't just personal preference. It became the foundation of his management philosophy when he eventually took control of Lehman Brothers. Fuld believed that the company's problems during the Devil's Casino era weren't caused by poor risk management or toxic internal competition. In his mind, they were caused by disloyal executives who put their own interests ahead of the company's success. He was determined to fix this loyalty problem, even if it meant creating new problems in the process. When Fuld became CEO, he implemented a compensation system designed to trap employees at the company. Most bonuses were paid in company stock that was locked up over several years and couldn't be sold. This wasn't just a retention strategy, it was a loyalty test. Employees who wanted to leave before their stock vested would forfeit millions of dollars in compensation. The system made it financially devastating to quit, regardless of how attractive outside opportunities might be. The stock-based compensation structure seemed innovative at the time, and it would later become common in finance and technology companies. But Fuld's version was particularly aggressive. He wasn't just offering stock options as upside potential. He was converting traditional cash bonuses into restricted stock that employees forfeited entirely if they left. This created a situation where senior executives had tens of millions of dollars tied up in Lehman stock that they couldn't access, making them completely dependent on the company's performance.